All right. Good morning, good afternoon, traders. Today is Friday, December 27th, 2024. I hope everybody's having a good day. Um, what I'm going to talk about is the newer or modified version of the original 112 trade. And I'm going to show you trades that I am holding, and I'm going to show you how and what I did in the last week, right? So last week on Wednesday, the Fed lowered rates by 25 basis points as expected. Their outlook was a little more hawkish. So now the market went from expectations for a 100 basis points worth of cuts next year to now market is expecting, I think it's about 50 basis points now. So not as aggressive on the rate cuts as the market wanted to. And I don't think we got a whole lot of new information. But the market did throw a tantrum, and we saw a 3% down day on last week on Wednesday. Volatility spiked. We saw VIX get as high as 27. Now I know that some people may be comparing this kind of a volatility move similar to what we saw back in August. I don't think we were quite there yet, but also don't think that we were too far away because in all things being equal, what we saw on August 5th, because it happened overnight, because it happened on a Sunday, right before the U.S. markets were, equity markets and index markets were open, there was no market, right? So we saw futures dive, VX got as high as it went to 20, 27, 30, whatever it was. And then at 1 o'clock, when the VIX opened for trade, we saw VIX just completely blow out and the market essentially disappeared. There was no bids. Asks were, in the next universe. So the markets were so wide, we couldn't possibly do any business. We weren't there last week, but with the VIX getting up to 27, right, we were fairly low. And then next thing you know, VIX is at 27. That definitely put pressure on some of the positions that we had on. But one thing, and this is a key difference between what we have going on now versus what it was like back in August, is that, and I hope that this was the same for everyone, buying power requirement didn't get anywhere near to where it was back in August. Or let's just say, if you kept your buying power requirement fairly low, I didn't see my buying power get much higher than in maybe mid 40s, right? Whereas if similar kind of a move in the volatility happened and we didn't have layers of hedges on, I have a feeling that buying power requirement would have gotten much higher, potentially forcing us to act as in, close out some positions, maybe rolling positions, because rolling positions does free up some buying power, but things would be moving pretty fast. And I think the easiest and the fastest thing to do would be to close. And that would potentially be the worst time to close positions. I'm going to go through and show you some positions that I have on. So I still have a couple of hedges that are left over. Now, I don't know if I am going to use these. I am 100% going to use these if I am forced to adjust any of my income trades. But I harvested about, I think 3 hedges were closed out completely. One was partially not closed, but adjusted, where I rolled the long leg of the put debit spread higher to collect a credit that I needed to pay for a debit. And that debit was from rolling my naked puts down and out. So a couple of hedges that are still left over. So this one has 84 days. I have another hedge with 84 days, but farther out of the money. So this one, it doesn't have a ton of extrinsic value. This put debit spread is currently, it has extrinsic value of $325. So if I was, put in a position where I had to roll something and had to pay a debit for that roll, I would look to get out of this put debit spread. And, obviously, if I was forced to adjust my income trades, odds are market's moving lower. So I would assume that the value of this put debit spread would increase as well. But, anyways, I would look to sell this put debit spread for whatever it's worth and cover any debits that I would have to pay to adjust my income trades. This is another put debit spread with a little bit more time. This is 94 days with put debit spread a little bit closer to at the money. This one is worth about $310. So if nothing bad happens, odds are these put debit spreads will expire worthless. And that's fine, right? We don't want to collect on our insurance policy, because if we are collecting on our insurance policy, that means something bad is happening. This is one position that I have on right now. And if you want to look up how this trade evolved from where I took this trade was initiated 42 days ago. This was originally in the December 20th expiration cycle. This was a 11X trade ID 3054. So if you go on Discord, punch in 3054 in the search where I post my trades, you will see a post with all of the follow-up adjustments, everything that I did. And there were a few. I initiated a trade. I rolled my naked puts up and out, collected more credit. When the market went down, I was forced to roll my naked puts down and out, paid a debit, and then I had to sell put debit spread to cover the cost. And then what I just did recently, I think this was yesterday on the 26th, I rolled up my naked puts once again, up and out, collected a credit, and I added another one put debit spread. So this is a fairly hedged income trade, right? So don't have a ton of delta. It's at about delta 13. It does have negative vega. So if volatility continues to pick up, it's not going to be fun, but you can see that the short naked puts right now, 42 days out, and their delta's at about 14, 15. So we're not quite there where I have to do something, but if my short put delta gets above 20, 22, 25, it's time to act. For me, that's my guideline. If you want to wait for them to go in the money, and that's fine too, just keep in mind that it's going to be pretty difficult and a lot more expensive to make adjustments once your short naked options are starting to now approach that in the money territory. So this trade was adjusted, and the last time I rolled these puts to 56.50, this was, I'm just trying to check to see when that was. I rolled these puts on the 18th. I sold these puts for, the 56.50s. This is what I rolled to yesterday. The puts that were pressured when the market was coming down, those were originally sold for $39.25, and then yesterday I bought them back for $5.35. And the difference, right? I sold those. Those were 5,700 strike puts that I sold for $39.25. That was on the 18th, and then on the 26th, right, 6 days later, the value of those puts went from $39 down to $5. Right. So that's the idea. And hopefully you guys are following along. The idea when I roll these puts, I'm not just rolling them for no reason. The reason why we roll them is to give ourselves a little bit more time and potentially safety. Right. If I had to roll this 56.50 right now, I'm paying about $28.50 for it. I would be rolling it out for more time. So from 42 days, maybe to 49 or 56 days. And then I would try to roll it to where I could collect at least as much as what I'm paying to close this put. right? So if I'm buying it back for $29 and I'm rolling it to 56 DTE, could probably roll it down to, I don't know, 50, 55, 60, right? And collect 31. So I'm paying 29, I'm collecting 31. There's your $2 credit, and I'm rolling them from 15 delta down to about 13 delta. So I'm on the hook for a little bit longer, but I have a little bit more safety. I have from 56.50 down to about 55.60, right? So almost 100 points or whatever. So that's the idea. And then I guess the key factor in these trades is that once whatever's causing the delta to rise, right, either volatility is increasing or the price is moving against us, once that condition is going to change, market may go up, volatility may go down, or both. Kind of what we saw last week on Friday, right? Once that happens, the puts that you're rolling to are going to lose a lot of value, and it's going to happen pretty fast. And that's where these trades will come back to life and potentially profitability. I'm thinking, I mean, we can go back and try to model something similar just to see what a trade would look like with the previous 112 version, where a put debit spread was only 50 points wide, and put debit spread and the naked puts were in the same expiration cycle. I have to believe, based on the experience, I mean, we've had some down moves, we had some volatility spikes. I've traded the original 112 for a while, and I do know that once we saw a move lower and volatility increase and position was pressured, it took quite a bit of time. It took a little bit longer than just 1 week for the position to recover. So looking at this, I am convinced that treating this trade as income and a hedge, um, it could potentially help you understand this trade a little bit better, and also this trade does recover a little bit faster because your income portion of this trade has less time until expiration, which means, we know that options with less time until expiration have a faster rate of decay. They're also a lot more sensitive to volatility. So the two sides of that coin is that when the trade is pressured, yes, the naked puts that are closer in time, they are a lot more sensitive to volatility. So if volatility spikes, they're going to get hit pretty hard. But then volatility reverts, these short naked puts will decay, and they're going to lose a lot of that premium due to volatility collapse. So these do recover faster, which is a plus. But the minus is that if the volatility goes up and then instead of reverting, it goes up again, right? You can find yourself in quite a bit of trouble with this trade unless you are proactive and you know when you're going to roll your position, if you're paying for it, what you need to sell, or how you're going to pay for your adjustments. So all of that stuff needs to be thought about before you take these trades. This is another position, and this position is a little bit safer. I did make adjustments in this trade. I believe there was only one adjustment. I initiated this trade on November 20th, and then on 12/11, and this is a trade ID 3056. So if you want to go and look at the steps that were taken, all of the details about this trade are there. On the 12/11, I rolled my puts. I rolled them higher from 55.75 up and out. So I rolled them up, took on a little bit more risk, rolled them up almost 200 points and out from December 23rd to January 10th, collected a credit, which was great. And then when market went down after the Fed, I was forced to roll. The 57.50 down to 55.50. So I rolled them down 200 points and out from January 10th to January 24th. Now volatility came in. The short naked puts recovered. There's still a 200 point wide put debit spread is in place. And now my front month, which is my income portion of this trade, has 28 days to go. And even with today's push lower, these 5550s are currently at about delta 8. They still have $1,100 worth of extrinsic value, so I'm not going to close them out just yet. But I think in the next couple of weeks, as my short naked puts lose, 80, 90% of their value, I'm going to probably roll them for more time. All right, so I'm going to add time to this trade. I'm going to probably have to roll them up, right, to collect the premium, and then I'm going to spend some of that premium to potentially add another put debit spread that will only increase the hedging property of this position. Right, so I have two parts in this trade. I have the income part, and then I have the put debit spread, which is the hedging part. And this put debit spread, I think that some people make the mistake of falling in love with the idea, oh, I have these hedges, all these puts, all this. If you're not spending these to make adjustments, they're going to expire worthless. You're just not fully utilizing the trade the way it's supposed to be utilized. Let's keep moving forward. There is another 1-1x trade, and as you can see, right, these trades, they're all very similar looking. So it's not, like one is better than the other. They're just have different time until expiration, but the structure of this trade is no different than this this one trade that I just showed you from December 23rd. It has 28 days. The next trade has 31 days. And, these trades are now starting to be really look-alike because they were adjusted where I roll down and out my naked puts when they got up to about, I believe they were around delta, maybe 20. Some of them were as high as 22, maybe 24. I rolled those out for more time and rolled them down for safety. There were several tranches where I was able to roll down and out and collect the credit, so I didn't have to sacrifice my put debit spreads. And those that I could not collect the credit, I had to pay a debit. I went ahead and I sold some of the put debit spreads that I had on in order to cover the cost of rolling the naked puts down and out. And then, again, volatility came in, market bounced, and here we are. A lot of these positions are back to where they were. And net, I am slightly higher than where I was before the initial push lower after the Fed. Another trade, as you can see, very similar looking. And I think that the focus here should be on not so much on our risk graph at expiration, even though it is important to understand what this risk graph looks like at expiration. But I think what's more important here is the shape of our T plus zero, because that's where our risk is, right? We're sliding up and down on this T plus zero line. Don't worry about so much about the risk graph at expiration unless, you're playing for the profit at expiration. But between now and then, there's still 35 days. If you don't take care of the risk today, you may not get to risk graph at expiration. You can get blown out of this position, right? So you have to worry about your T plus zero line, worry about the shape of your T plus zero. And then if you take care of the T plus zero, eventually you will live long enough to get to your risk graph at expiration. Because over time, T plus zero will eventually morph into our risk graph at expiration. You just have to make sure that you're doing the right things to control your risk, whether it's your exposure to volatility or your price risk or delta, to stay in the trade long enough to get to risk graph at expiration. Hopefully that makes sense. And you can see that, I just changed the projected T plus zero lines over time, right? So this thin blue line is T plus zero today. This red line is T plus 9. So this is what my T plus zero would look like 9 days from now. This darker charcoal or black line is T plus 18. So the difference between each one of these lines is 9 days. So every 9 days, as you can see, T plus 0 is going to improve. But if you let the price slide down far enough on the T plus 0 or T plus, which is today, right now it's going to be a lot harder to hold to get to, that T plus 27. So worry about T plus 0. And, while we're on the topic of T plus 0, if you want to take a screenshot of this or just, blink twice fast and you'll try to remember of what this T plus 0 looks like right now, right? And this is a calendarized version of the 112 where the put debit spread, it's not 50 points wide, it's wider, it's farther out of the money, and it has more time until expiration, right? These are in the May 16th expiration cycle, and the naked puts are 35 days away. The idea, the exercise here, guys, is I want you to pay attention to the T plus 0 line, right? What it looks like. And then we can go ahead and try to, um, to keep it simple. Let's just go and look at a typical 112, the way we used to trade the 112s. Maybe it's a 63. It really doesn't matter, right? Whatever the time frame was, they're all going to look the same. They all have the same T plus 0 lines. That's what I'm trying to show you. So I liked to do something like, maybe 50 wide around delta 35. Let's see what that looks like. Right, so 58.75 for buying one, and then we go down to 58 and a quarter, and we sell one. That's our put debit spread. Right, and then we would sell two naked puts in the same expiration cycle. Maybe it was a delta, I don't know, 7. Let's see what that looks like. All right, so that's the original 112, and that's what the risk graph looks like. I know that, risk graph, so this thicker line looks different than what we're just looking at, right? The calendarized T plus 0, right? It looks more something, well, let's see, maybe I can draw on here and show you, right? So the calendarized version looks something like this, right? So we don't have this trap, okay? But the T plus 0 line, whether you're doing it all in the same expiration cycle or you're splitting your put debit spread and your short naked puts into different expiration cycles, T plus 0 line is still going to be fairly similar. I don't want to say the same. The Greeks do change a little bit because you have a little bit faster decay on the front month of your income portion of your trade. Your put debit spread is expiring a little bit slower, so there's less theta. There's slight difference in Vega readings, but the shape, right, the curvature of T plus 0, you're going to be in trouble, right, if you let the price slide down this T plus 0 line and you don't do anything about it. So whether you're still trading it the way we did before, or if you're trading it now calendarized, right, essentially this is a diagonal spread, the T plus 0 is still the same. The risk is still in the same direction. You still have exposure to Vega, and you still have exposure to positive delta, right? So not much has changed. And then if you want to say, well, how is this different? Let me just get rid of all these drawings. Why don't we instead, right? So we have this put debit spread. We can leave it as is, and we can go and move the naked puts. So let's say we're selling them for 19 bucks, right? We're going to not do it with 63 DTE, but we'll go to maybe 30 DTE. And again, I'm not making the case that, you have to go to 30 DTE or 60 DTE on the put debit spread. you could do whatever works best for you. What I'm trying to show you that if I was looking to sell my naked puts for $19 and keep my put debit spread where it was, right? So now I'm going closer in time instead of 60 whatever days. Now I'm only 33 days, so half the time. And then I'm going to go and sell these naked puts for $19 or close to it, right? Maybe it's 5,600 or delta 10. See, that changes our risk graph at expiration shape, right? This thicker green line, but the T plus zero shape didn't change much, right? And now I don't really care about the shape of my risk graph at expiration, right? Whether it has this big fat trap or skinny trap or whatever you want to call this trap, right? My goal here is to hold my naked puts, which are about uh, they're about 7% out of the money, right? 5,600 from today's prices at about 7% out of the money. So I want, if I sold these 5,600 puts for $16.90 or whatever, 17 or 16 and a half, I want to hold them long enough for them to lose maybe 80, maybe 90% of their value, right? If I sold them for $1,900 and I can buy them back for maybe, $200 and collect $1,700 in the process and get out, right? If I get out, I have collected the income part of my trade is done. And that leaves me with a put debit spread, which is probably not completely paid for. In this case, it would be, but the way I set up my trades is it would be fully paid for, but it would have a lot less value. But you can see that once the front month expires, that leaves you with a put debit spread with, right? If we started this trade with put debit spreads in the Feb 28 expiration that had 63 days, and then we waited maybe 30, maybe 33 days or maybe 30 days for the front month to expire. That leaves us with this put debit spread with about 30 days to go until expiration, and it's completely paid for, which means that for the remainder of the time, these put debit spreads could potentially serve as a hedge for some of the newer trades. When you put on another 112 and you split your put debit spread and your naked puts into different expirations, your naked puts are going to be closer in time, right? Which will give you more sensitivity to volatility and delta. But now you will have this leftover put debit spread plus another put debit spread, which is part of the new 112 trade, right? So now you'll have two naked puts and two put debit spreads. And if you're forced to make some sort of moves to save your or to adjust your naked puts, you have put debit spreads to potentially adjust or to close and cover any expenses to roll your naked puts down and out, right? So that is um, this is what the trade is in a nutshell, right? So if you look at the trade that I was showing you earlier, this was 3054. That trade has gone through a full cycle where I took the trade, then I ended up, I'm going to pull it up. So I don't want to tell you something that isn't true. So I took the trade and then I rolled my naked put up and out. So I collected a little bit more credit. You don't have to do that, but essentially when your original naked put loses most of its value, you can choose to close it and leave the put debit spread, right, to be left over hedging other positions, or you can recycle that same put debit spread and sell something else against it where you're collecting additional credit, which is what I did. And then, right? After I rolled up those naked puts, market came under pressure. I had to roll those naked puts down and out. I paid a $3 debit. And to cover the cost of those put debit spreads, to cover the cost of the roll of the naked puts, I had to go and reach for a put debit spread, which was in February 21st expiration cycle. I had two of those and I sold them for $4.50. So I paid a $3 debit to roll my naked puts, and then I sold the put debit spreads that I had left over from another trade for $4.50, netting about $1.50 net credit for the adjustment. Okay, so that's a full cycle. So if you want to get a better understanding of, step one, step two, step three, right, you could refer to trade number 3054, and that's going to kind of help you put it all together. So it doesn't really matter if you're keeping your nakeds in the same expiration cycle or if you are moving them closer. Obviously, there's few benefits. There's some key differences, right? Putting your naked puts closer in time will require a little bit more buying power, right? So your broker will ask for a little bit more money up front. But again, you have to find that balance, that middle ground that works best for you according to your goals and your needs, right? You get faster decay. You get that's plus, right? But in minus is you have to put up more buying power to get that faster decay, and you are exposed more delta, and you're exposed more due to Vega, right? Or you can keep it all in the same expiration cycle, which is the way we did it before, except I don't think that the 50-point wide put debit spread will do much, because what tends to happen is, let me just put it back to delta, what is it, 19, right? So here's where we are. And now, looking at this trade, right, the shape of our T plus zero is the same. But if the market dives, let's say we go down 3, 4, 5%, right, and we're technically in the trap, and we might, get this warm and fuzzy feeling that, oh, we're safe here, but we're not. The problem is that in this trade, you have your naked puts that are being pressured, but the put debit spread, number one, 50 points is not that wide. So all of the Greeks kind of offset each other. So you don't get any benefit from Vega expansion, even though this put debit spread technically is a Vega positive spread, but it doesn't have any Vega, right? If you're short one put and you're long one put and they're too close to each other, whatever Vega you have in your long put gets offset by that short Vega on the short leg. So you don't really get the benefit. And the price of this put debit spread isn't increasing fast enough to be worth anything to consider, harvesting to roll your naked puts. That's the key difference. When you have your put debit spreads with, 120, 150, 180 days out, because of that time until expiration, right? And they have to be wider than 50 points. They have to be, I think 100 points isn't wide enough. I think they have to be 250 points plus wide, 250, 300, 400, 500, 600 wide. It all depends on when you're going to put them on. You also need to kind of understand that, when volatility is low or volatility is high, what makes the most sense. But the wider the put debit spread, right, the more Vega you will have in that will help you to hedge off some of that Vega expansion. And then because of all of that time until expiration, that put debit spread is going to increase in value. Where if you're forced to make an adjustment to your short naked puts, you can either roll the long leg towards the short leg and collect the credit. You can roll your short leg of the put debit spread closer to the long leg, collect the credit. Whatever you're going to do to collect the credit that will go towards paying the debit if you are, in fact, paying a debit to roll your naked puts down and out. So that's pretty much the only difference, really, between what we did with the 112 before, and we just moved our naked puts closer in time. Yes, we have more risk, we have more or faster decay, and we have a slightly different plan where before you couldn't really move the put debit spread to help your naked puts, putting them on different expirations and allowing put debit spreads to build up, right? If you, just like I showed you, right? If you have the naked puts expire 30 days, another 30 days goes by, but your put debit spread has 150 days, then 30 days later has 120 days, another 30 days goes by, now you have 90 days. By the time this put debit spread has 90 days to go, you already have two other put debit spreads on top of this one. Right, so now you have some material to work with in case you have to adjust your naked puts. You have three put debit spreads. They're probably much wider than just 50 points. So now you have something to sell in order to roll your naked puts down and out. I hope this gets you guys to think about these 112s, right? Even though they're looking different, they're not much different. Risk is still the same. Just we're using different tactics to manage these trades. Let's just go for a few more of these trades. Again, I don't want to spend too much time on any one of these, but as you can see, yes, I rolled them down and out. You know, they still have that 112 structure. Put debit spreads and naked puts are in different expiration cycles. This is probably the most pressured 112. This one has been open for 17 days. I believe it was adjusted as well. I adjusted every single one of my positions on that initial dip. It just hasn't recovered just yet. And we can see that I rolled. I'm going to look at my trade log to see. So yeah, I initially sold the January 17th 57 tens. I sold them for $15 and $16.50. So $16.50. And then when the market dipped on the 18th, I had to buy those back for $60.40. But I sold, right? So I went from January 17th, I went to February 7th, and I sold 55.50s, which is about 150 points lower. And I sold these puts for $61.05. So I rolled down and out and I collected a credit. Therefore, I didn't have to sacrifice any of the hedges that I had. And we can see that, the original price of these puts were $61.05. And now they're going for about $22. All right, but there's still a lot of time left. These puts are, they haven't lost enough to make this trade net profitable. Right, these puts are still worth about $2,200. So, with 42 days to go, I have at least 30 days to hold on to this trade. And again, if this trade starts to get into trouble right now, my short puts at a delta 11. Do I need to do something? I don't think so. But once the delta starts to creep over anything over 20 for me, for those of you that traded iron condors with me, remember, we sell far out of the money options, which gives us initial implied high probability of profit. Don't just fall in love with the idea that, oh, I have a 75, 85, 95% probability, blah, blah, blah. That goes away very fast if implied volatility rises and the price is moving against you. Before you know it, your high probability short puts are now delta 50, which have 50-50 odds. And hopefully you're doing something about it to defend your position, because if you don't, once they go in the money, you start to think about, oh, maybe I'll take assignment. Maybe I'm, now you're starting to think about what you're going to do. You got to think about all of that stuff beforehand. And before you let them go in the money, you have to know that, you're going to act when maybe in the delta goes from 10 to 20, maybe delta goes from 10 to 30, whatever the case may be. But don't wait for it to go in the money. And then you're going to start to scramble because at that point, in my opinion, adjustments are just way too expensive. You can roll far enough out in time and in price. So best case, you're maybe just rolling your nakeds sideways. And who knows, the market could trend for a lot longer than you think it can. And if you catch one of these long, downtrend for 3 months, now you're just punting, you're just rolling your nakeds sideways for 3 months. By the time you get out of that trade, you're going to be mentally drained. Hopefully only mentally. Right? So don't let it get too far away from you. Act sooner rather than later, and uh, don't renegotiate your trade plans once you're in the middle of the trade. And this is the most recent trade that I put on. This was just 1 day in. Obviously, we just put this on with the market being down, volatility is up. Um, the naked puts are at delta 13. There's really not a whole lot to think or wonder. It's going to show a drawdown. It's just what it is. And, you could look at it a couple of weeks out into the future, assuming volatility is going to revert at some point. This trade is going to autocorrect. And if things get worse, then I will have to deal with my income portion of these trades, which is my short naked puts. I will have to roll them down and out. And if I can't collect the credit, I have a few tranches of the put debit spreads that I will look to sell to cover the cost. And that's my game plan for this trade. Very simple. I see that there are a few questions, and I think this is a great question from Time Merchant. In your trading, what percentage of your positions are calendarized 112 and defined risk SPX broken wing butterflies? I actually have these two trades in two different accounts. SPX butterflies are in a portfolio margin account, and anything that utilizes span margin is in a different span account. So I don't necessarily look at them. How much do I allocate one over the other? Because I think if I gave you any number, it's a wrong number for you, right? So I don't want to give you information that is wrong. Because if I've traded, broken wing butterflies on SPX for the past, 15 years, and I'm utilizing, 70% of my available capital to trade these SPX butterflies, and the remaining 30% or whatever that number may be, I'm utilizing for, span margin, these undefined risk 112 calendarized trades. And you try to do the same thing, except you have never traded a broken wing put butterfly in SPX, then why would you allocate 70% of your available capital to that trade? I always say that the best way to scale or to allocate capital is based on your experience and your results. If you are consistently profitable in any trade, you could possibly increase allocations to a point where you're comfortable, right? Because, with those SPX put butterflies, if each one of these trades is going to lose, I don't know, maybe $300 or $400, but your comfort level as far as losses go. And I've seen, situations where people have, six-figure accounts, but they can't get over you know, $2,500 loss. I don't know if it's the ego. I don't know, for whatever reason, right? So you have to size trades according to how much risk you're willing to take, how much money you're willing to lose if you are forced to stop out of your trade. So I think allocating asset or allocating towards different strategies based on your experience, based on your risk profile, right, and based on your results. If you have experience, you've traded broken wing butterflies for the past 7 years, and you're just a break even trader, I don't think you should allocate a lot of money to that strategy. You need to fine tune the strategy to where you're consistently profitable in that trade, and only then you can start to allocate more and more to where it makes the most sense. But with the SPX broken wing butterflies, right, I have two, maybe three positions going at the same time. There are a 10 lot. Each 10 lot takes up about $50,000 in buying power, and that's where I'm at. With the 112s, I think that it is important to keep an eye on your overall buying power usage. Again, you know, assuming you have multiple layers of these put debit spreads, assuming you have a couple of Vega hedges in place, right? When your net long um, puts to your short puts is a ratio of at least 2 to 1, maybe 3 to 1. If you can get to 4 to 1, that's probably the best. Anything beyond that, you may be slightly overhedged. So, assuming you have those in place, you can continue to add trades, um, such as this one here, to where you're kind of in that, you know, I want to draw a line somewhere, maybe 30-35% as far as buying power usage. And I'm referring to Tastytrade because, Tastytrade does lower the bar as far as how much buying power they require to put a trade on. But when things get crazy, their buying power requirement is going to go through the roof, right? So if you lean on that low buying power requirement to put a trade on, right, and you push a little bit too much capital into your trades, and then the market goes down, volatility goes up, and Tastytrade buying power requirement all of a sudden, went from 150,000 to 275, but you only have 300,000 in your account, right? You find yourself in a very difficult spot. So I wouldn't so much worry about how much am I allocating to one versus the other. Just with the 112s, keep an eye on your overall buying power usage, right? Don't put on too many trades because the broker only takes very little to put the trade on, right? And then, you also want to keep an eye on your total delta to your net lick to kind of guide you, right, where you need to add new trades. Like, for example, right now, just a few days ago, right, I was right to where I wanted to be, right? The buying power usage was below 30%. My delta to my net lick was at about 0.01%. And with today's move, well, I added a trade yesterday and I rolled one trade. So that kind of got things back to that baseline. So with today's move, right, market's down, volatility is up a little bit. My buying power usage in the mid 30s, I don't know, it's like 37 or 36 now. And my, right, because all of my positions, they resemble this one position, right? I'm long delta everywhere. And if you pay attention to the delta number, if I start to bump volatility up, you see my delta starts to increase without price moving. And then if the price is moving down because of my short gamma, right, my delta starts to increase on the way down. And my delta is also increasing when volatility is increasing. So now with today's move, market's down, volatility is up. Naturally, my delta is up also. I'm at a point where adding new trades just doesn't make, I have no room for new trades, right? So I let these kind of factors dictate when I add trades, not so much, hey, I'm going to allocate 30% here, 20% there, not like that, right? I add when I have room to add, and I stay out when I have no room to add. Hopefully, um, this kind of gives you a better idea. For the past year of trading the LT, I do not have a single trade close in the trap. Okay. And that makes sense, right? The market has just been going up. That is a major reason I am moving to the calendarized. Yeah, I agree with that, right? So, playing for the trap in a very strong bull market. And I don't care about August 5th to make the case that this is not a strong bull market. We are in one of the strongest. If you look at the chart, if you look at the chart of the S&P and then you just zoom out 5, 10 years ago, right? Go back 5, 10 years. And if you tell me that right now we're not in the strongest, the rate of change of what the S&P is doing right now, we are in a very strong bull market, right? So expecting to catch a trap in this kind of um, a market move, so don't be surprised you're not getting a lot of trap profits. And you know what? I think the one of the only ways is to really play for the trap is to take size way down, and instead of doing 1 1 2s, do a 1 1 1. Go to MES maybe, right? To for a smaller contract, and assume that you're going to get assigned on the naked put, right? So this way, you're not just getting the trap, you're also getting assigned, which kind of sucks, right? But this isn't something that, well, I shouldn't say that, this isn't something that can go to zero. Of course, market can go to zero, but we have to assume that market is going to have a positive drift over long periods of time. So as long as you are able to hold that one contract or whatever you get assigned on, right, eventually you can get yourself out of that position. And maybe, just maybe, right, the market pulls back far enough where you're not getting assigned on your naked puts, but you're definitely catching the trap. And I had one of those last Friday. I closed out a trade. It didn't expire in the trap, but after the initial move lower, after the Fed, right, the market pulled back far enough where my put debit spread, which only had like 2 days or so until expiration, and that put debit spread went in the money, and I didn't wait for the market to close and to take it through the settlement process. So I didn't make the full trap profit, but I definitely made a lot more than what my initial credit was. That trade closed yesterday, and for those of you that are curious to see what that did, hang on 1 second. I will tell you what the trade ID was, and you can go on Discord and check it out. Bear with me. This was last Friday, was the 20th. That trade was 3048. 3048. And that's really the only way to catch the trap is, you have to assume that the market might pull back to where you might face assignment. But, if it goes far enough to push the price into the trap, but not too far to where you're getting assigned, that's the best case scenario. And for that, you will need two-way market. And, just looking at, again, this is not the best charting software, but this is pretty darn bullish. All right, this is 2023. Remember the October 2023 low? Sure, there were a few and quite a few pullbacks along the ways, but this is pretty strong. You're probably going to get a lot more traps if the market starts to move the way it did in July of last year, right? So we had from July to about October, what looked like was a downtrend in the context of a longer term uptrend. We did have, from about July to October, we had a series of lower highs and lower lows. So I would assume that this is the kind of market you would want to see in order to catch some of your trades in the trap. 20 delta on the naked put is a general rule you use, or does that depend on other variables? For me, this is a personal preference, right? Where, 30 a bad number to use? No, I just know that the higher the delta, right? Especially, um, especially when you consider the fact that when you have to roll. Let's just go here, right? This is a trade I put on yesterday, and this one has 42 days on that put, on the short put, right? And I don't know what these numbers or how accurate they are, but supposedly this represents um, implied volatility of this specific option chain. I don't think that vol is at 10 right now or anywhere near that. But assuming that the market is pulling back and volatility is increasing, anything that is closer in time, right? We're just looking at 42-day, 49-day, and 56-day. Anything that is closer in time will probably get bid up more, meaning that implied volatility of options that are closer in time will go higher, making these shorter time until expiration options more expensive in implied volatility terms, right? So the longer I wait, the more expensive the front month becomes relative to the back month, which means that on the roll, if I'm paying more for my shorts than what I'm collecting on my new shorts, right? That means I will collect less credit to roll because I have waited too long. And the longer I wait, the more expensive this roll will become. And it will come to a point where if these options will go in the money, there will be very little to no extrinsic value. So now on the roll, all I'm doing is I'm exchanging intrinsic value for intrinsic value, right? So that's why I don't want to wait for these options to go in the money. I would rather do it sooner because eventually, if volatility collapses and price reverts, right, they're going to lose a lot of that extrinsic value too. So I would rather be a little bit more proactive. 20, I use 20 as, again, I've traded iron condors for a long time. And my kind of rule of thumb was if I sold a spread where my short put was at around delta 10, when it gets to delta 20, it doesn't mean I have to roll when it's delta 20, right? My thing with iron condors were um, if my short put on um, on my credit spread gets to about a delta, goes from delta 10 to delta 20, I need to find a hedge. And, I used delta hedges. Um, but my trigger to act was when my short strike delta would reach 20. It could get to 22. It can get to 25, right? It doesn't mean, oh, now it's at 25. I missed it, so I'm not going to do anything. That's not the way to do it. It's just when it's 20, when it's 18, you got to start to think, all right, do I know what I'm going to do? Because, let's say today, right? Let's say market is weak and we have a delta on my short option is at about 18, right? And we're going into the close. And I'm sitting here. The question I'm asking myself, do I want to do something now before it gets to 20? Well, naturally, we think, what if the market's going to bounce tomorrow or Monday? Am I going to do something too soon? Am I going to just waste, right? That's how we think. Or I can say, all right, it's a delta 18. I'm not quite there yet. But what if on Monday we open and it now is delta 30, right? What's my first move? I know what my first move is. And if I'm okay with taking the chance of, on the next day open, that short delta goes from 18 to 30, there's no thinking. If that thing is at 30, I got to move. There's no more, well, let me wait and see, let me ask here and there. You have to know what you're going to do. So I would probably, to be honest, I would probably rather do something when maybe it's a delta 18. Why wait? If it's too close. It's too close and you're just leaving everything to chance. Like, what is the chance of, delta going from 18 back to 15 or going from 18 to 27? Right? Because we have to assume that the following day market's odds of going up or down is 50-50. So maybe if it's a delta 18, and let's say if I'm short two here, maybe I'll roll one, right? Kind of take 1 foot out and wait and see what happens, right? Maybe I'll just say, you know what? I don't want to sweat it on Monday morning and scramble and look for whatever or wait for Sunday night and, look at this thing and worry or think about it. Maybe I'll just do it now on Friday before the market closes. And you know what? If the market reverts and the delta goes from 18 back to 15, who cares? But, I'm taking a proactive approach. All right, that's just me. You don't have to do it the same way. I think it makes sense to me, and that's how I like to do things. Sometimes, I made an adjustment in the last week when I was making adjustments. Some trades, the market was just moving a little too fast, and with the VIX going from whatever it was to 27, my short option delta overshot 20. Some of them were as high as 22. Some of them was 24. Some of them were 26. And I still made my adjustments. I just couldn't get to them, right? Because that move all happened in one day. So it's kind of like the rule, but, you know, it's more of a guideline. It's not a rule. I don't really like rules because, if you do something that doesn't go along with the rule, it confuses more people than it helps and becomes a problem.